Hello, everybody. We have participants joining. Wanted to just take care of some housekeeping items before we jump in on the information. Uh, uh, First of all, this webinar is being recorded. It will be posted so that everybody can come back and look at it and review it should you desire or share it with others within your company. As we think about questions, it's really doubtful that we're going to be able to have time at the end to do a Q&A session. Danny and I have a lot of material here that we're going to be covering. However, we do want to make sure that we answer your questions. If they're pretty clarifying, simple questions, we will be able to get to those as we're going through this. But if they're a little bit more in-depth, we'll get back to you via email, but we will capture all the questions that go into the Q&A that are on here. You can also email Danny and I directly if you have our emails, which we will post, and Eric Schmidt, who is the coordinator for the SipSource program with the WSWA. As we get going, a theory that we have and that we really do believe in it, SipSource, is that more information is better. And with that, as we go through this webinar and the material we're covering, we're going to be primarily using SipSource data. However, we will be augmenting that data with some other business partners and some other data providers. Primarily, we'd like to say thank you to the Beer Institute and to Nielsen IQ for providing us that data so that we can paint a better, much more rounded out picture. Thank you very much for joining. We're excited to kick off our holiday webinar. Danny and I as I said, have a lot of material to cover, and probably best that we just jump right in. First thing, just as a reminder, what is SipSource? And SipSource is aggregated depletion data across participating wholesales. We'll show you the list of that wholesale list here in a second. There is no sampling or projections in this. The model is just simply we take the actual sales, the depletions from a wholesaler to a restaurateur or retailer and aggregate those up. That data is then attributed by our partners at VIP so that we can really dig in deep. You can see many of the ways in which we're able to do that here, and we will demonstrate that as we go through that. There will be an additional exciting enhancements that will be added in 2024. We continue to improve on this tool and are excited to continue to make it better and more representative of market, and actually to go into more depth, detail, and functionality. With that, here are the wholesalers that are participating. And you can see that this is a really strong representation of what's happening in the market. We will be continuing to add wholesalers in 2024 along with NABCA data. And we all know the impact that NABCA data can have, especially on the spirit side of things. With that, 2023 has been a difficult year. We all need to face up that it has, in fact, been a challenging year. The data that we're going to be presenting with SipSource is through August of 2023. And as we look at that and we think about the mountain that we have left to climb, it's going to be challenging. But if you could, Danny, can you put that into numbers for us?
Sure. So first of all, this is data for wines and spirits from the SipSource database, and for beer, as Dale had mentioned, from the Beer Institute. This is on and off premise together. These are 12-month rolling numbers back through 12 months through October of 2021, right through till 12 months ending August of 2023. And frankly, I mean, it's not a pretty picture as the lines start to converge into negative territory. So let me just comment on a couple of things here. One is spirits, which is the solid green line on top. You can see just how strong volume growth was back in sort of the tail end of 2021 and into the first part of 2022. So part of the decelerating line there is just because the comps are extremely high. So it wasn't surprising to us that those rates would start to slow down. The other thing is that the dotted green line is spirits excluding RTDs. And obviously RTDs and the explosion in that sector has a pretty dramatic impact on total spirits. And so there's about a 2.5 point to 3 point differential between growth rates with RTDs and growth rates without it. The line in the middle is beer. That's been in sort of negative territory, but in the latest 12 months to August 2023, that's minus 3.5 points. And then wine is in red on the bottom. That continues to hover into single-digit negative territory. And we'll talk about sort of where that is coming from, because it's certainly not representative of all price tiers. And so that's certainly something we want to cover. That was a picture on volume. This captures both dollars and volume. This is from the Nielsen IQ scanning data. So this is just the off-premise channels that they measure. And a couple things I wanted to point out here. One is that there is a difference between dollar growth, which is in red, and volume growth in blue. That gets as high as a 6 point differential on beer. It's about a 3.5 point differential on wine. And then for spirits, the picture gets a little bit cloudy, because if we exclude RTDs on the far right-hand side, we still see that sort of trading up activity, because there's almost a 3 point differential between value growth and volume growth. But if we include RTDs, the differential is the reverse. So we actually see a depremiumization in spirits once RTDs are included. So with that, I'm going to ask Dale to sort of take us through where we've been over the last 4 years.
Yeah, and I think it's important to really look where we currently are and what's happening. And the last 4 years have been unprecedented. We had a once-in-a-lifetime pandemic, and that did impact how people shopped and how people consumed our categories. We saw an acceleration in online shopping. People really did rediscover the kitchen and do much more home cooking and more home entertaining. We will talk more about that, and I think it really created and really emphasized an impacted versus an insulated consumer. We'll talk more about what's going on there. In addition to that, when we think about where we are, geopolitical unrest is peaking right now, and really I'm not going to say a whole lot more about that, but it's also exacerbated by economic conditions, and we see high-level consumer debt levels are happening. Inflation and interest rates are high. Employment remains strong, but in general, I think we have an uncertain economic conditions, and in every supplier that I see out there who does polls, consumer confidence is really starting to come down, and we know that this is impacting the consumer. However, I think probably the most significant impact really deals with inflation and the amount of money that people have. Can you tell us a little bit more about that, Danny?
So here are the inflation numbers as per the Bureau of Labor Statistics. So this is a monthly report that they provide. What I've shown here is the inflation rates for overall CPI for food, for non-alc beverages, and then for the beverage alcohol categories. The gray numbers are kind of the peak level of inflation back in December of 2022. So we know that's come down, but it's not come down as fast as certainly the Fed would like it, which has meant some still high interest rates. But I want to point out a couple things. One is if you look at the beer numbers, they are considerably higher than the inflation numbers for spirits and wine. And that's one of the factors that's led to some high dollar growth rates for beer. In fact, beer has had the highest dollar increase of any of the three categories, partly because of those price increases. Spirits and wine, much less so in terms of its rates. But the other thing I wanted to point out is that there's a pretty substantial difference between the at-home inflation numbers that you see on the sort of top right-hand side versus the away from home, or think of that as restaurants, bars, etc., and the inflation rates there. So certainly the restaurant, bar, on-premise operators are taking up price significantly more than perhaps the supplier and distributor level. And that's something that has to be factored into sort of the consumer and how they react to pressured budgets, where one of the things they do is they don't go out as often. And it's probably not helping that the prices are considerably higher when they do go out. So I would say the frequency of their visitation has gone down. Although at the same time, I would say that when they're at a restaurant, bar, etc., they're ordering, quality or even perhaps better quality drinks than before. So if we sort of move from the economic side of things and then to the consumer side of things on the next slide, if we can get there. There we go. Now, there we go. So the consumer, I mean, the consumer is always sort of, they're the leading indicator. We need to pay attention to how they're changing. I've tried to capture some of those things in terms of how they're evolving in terms of their preferences, as well as how they're changing on the bottom in terms of just the demographic makeup, which we know is becoming more multicultural. The population's getting older, and there are shifts, frankly, within the country from certain states like California, Illinois, New York, to other states in the South and the Southeast. I would also say, though, that consumers operate often with a split brain. On the one hand, they're interested in saving. On the other hand, at times they're interested in splurging. On the one hand, they're more and more interested in health and wellness and how the products they choose to eat and drink fit into a healthier lifestyle. And on the other hand, there are times when they prefer to indulge and sort of put the health and wellness to in the rear view. So I think things like affordable luxury becomes a more maybe common term as we think about that split brain. But all of these things that we're seeing, including those economic impacts, are certainly having an impact on things like the luxury sector of wines and spirits, and what price tiers are doing better and or not as well as they were before. And we'll certainly touch on that. Before we do and look forward, let's take a step back, Dale, and look at where we've been over the last 4 years.
Thank you, Danny. I think it really is important to take a look back at what we've been through over the last 4 years, 3-4 years, and going back to the holiday of 2020, and we were coming out of shelter in place, and we saw a real good ramp up in the summer months of that. But when we headed into the holiday of 2020, there was a significant drop, especially in the December. So I think a lot of the trade ordered like they normally would for a normal November, December. Consumer takeout was really soft, and we just didn't see that reorder. So that end of December was the December of 2020 was really soft, and there was just uncertainty in every tier of the business, including the consumer. By February of 2021, we really started to see a significant divergence in trends between wine and spirits. Spirits had been outperforming wine for a long period of time. However, we saw that gap really grow. At the end of February, 2021, spirits were up 5.7, wine was up 1.4. By the end of 2021, spirits moved to up 7.9, where wine was down 6.2. We also had, again, another soft holiday season where the consumer really didn't respond. We did see significant restocking during 2021 in the on-premise, really led by spirits and also led by very high-end items. And in 2021, it's where we really saw that insulated consumer who had buying constraints on them during the shelter-in-place months start to splurge and really start to spend money. Then in 2022, everything really moved from COVID as the headline to inflation being the headline. We had very soft consumer takeout the holidays again in 2022. And overall, consumer spending started to moderate as those prices went up. And the pinch really started to be felt most at the high end. And that was really where we started to see the high end start to move into decline. Now we're seeing in 2023, and we would say that really what has happened in 2023, we've reset the base. We've had a lot of ups and downs and a lot of disturbance in the numbers. We've now reset the base for 2023. However, the question we're asking ourselves is really, which way is the pendulum going to swing, and to what extent is that pendulum going to swing? And if we think about that, and as we think about where we are today, and as we head into the future, Danny, what does that mean?
It means, Dale, that, I mean, the next 6 months are just crucial for a couple of reasons. One is, October, November, December are obviously key periods certainly for wines and spirits, as they always are around holidays and so on. But it also is critical because all of the noise over the past couple of years are sort of in the rear view now, so that what we'll be comparing against are kind of more normalized growth rates. And I think, again, the key question, as you said, is versus those more normalized growth rates, are we going to swing upward? Or are we going to continue downward? Or are we going to level off? And that's what we are anxious to see, and we'll offer our thoughts. I would also say that, in the past, dollars and dollar growth because of trading up and premiumization has certainly carried the day. But as that has waned, I think there's more and more questions coming from investors and retailers about volume growth, which has been difficult even for the spirits category, which was kind of the darling. That growth rate has certainly come down considerably over the last several months. And so we really have to think long and hard about how we're going to generate growth, volume growth, because certainly that's what the expectation is becoming, more so probably than ever before. So, like I said, those next 6 months are critical. As part of the numbers that we'll be seeing, I think it's important to keep in mind what the comps are or will be. And Dale, you're going to cover that here.
Yeah, and we're going to show a number of slides that look like this as we go through. And what we've done here is that we've broken into 3 time periods. On the left hand, you see the latest 12 months ending August. As I said, that's what our SipSource data ending is right now. We're working on September ending data. Then we have that 4 months, the last 4 months of the year. So what is the holiday and what did that look like last year? And then we looked at a little bit further out into Q1 of next year. And as Danny was saying, on the confidence side, is comps are pretty soft going forward. So even though in the last 4 months of the year in 2022 spirits were up, most of that growth came in December actually. But still, that 0.7 on a comparative basis is a relatively soft number. Then you look at those Q1 numbers, and you can really see that Q1 of 2023 is when we really started to hit the headwinds. And so with that, we're forecasting that we're going to see a little bit of improvement as we head into the next 6 months. Speaking of forecasting, Danny, we can talk about an add-in that we're going to have for SipSource.
Yeah, so Dale covered the Dale and Danny simplified forecasting methodology, which is him and I putting our heads together. But we think it's critical that the industry has a very robust and rigorous forecasting capability, and that's something that to some extent may be absent today. And we know that there's a lot of major decisions around the investments that this audience on the call are making, as well as the incentives on which performance is based. So a solution that is being actively worked on now is a robust and explainable methodology using largely SipSource data along with other data like scan data and some other external data using an AI-based modeling approach. That's something actively being worked on by SipSource as well as Kearney, the management consulting firm that has a lot of deep experience in beverage alcohol. You should expect that there will be some preliminary forecasts available in early 2024, ideally January, covering some categories just to get started, with lots more to come. And there'll be more information obviously about that in the upcoming months. But if you want to know more at this point, please feel free to reach out to Eric. So let's talk about some current trends. I'm going to cover really briefly beer. I know probably in this audience it's largely wines and spirits audience, but we also know that consumers don't, there's not that many consumers that exclusively buy any one category. Most consumers kind of graze across all 3. So on the beer side of things, I think I've already covered that there's been some pretty significant price advances. That's positively impacted dollar growth, but likely having a negative impact on volume. Within beer, some of the dynamics are the hard seltzer category, which was the darling a few years ago, is now down double digits. But on the other hand, that's being offset by gains in flavored malt beverages, which are for example, the Twisted Tea, Smirnoff Ice, Mike's Hard Lemonade of the world. Imports, led by Mexican imports and key brands like Modelo, Corona, are now larger than domestic premium. And you can think of domestic premium as the Bud Light, Coors Light, Miller Lights of the world. Craft is down about 5% now on volume. And certainly because they have a pretty large assortment in stores, they are susceptible to SKU rationalization at the shelf. The non-alc sector within beer is quite robust, larger than it is for wines and spirits, continuing to grow and continuing to gain steam. And then there's the kind of, I guess, at this point, infamous Bud Light story. And I've shown on the right-hand side volume percent change versus a year ago over a number of 4-week periods. And you can see what happened as of April of 2023 with a disastrous impact on Bud Light. And they're still down 25 to 30%. Being offset, on the other hand, by gains for Coors Light and Miller Light. So when you put all three together and add in some other domestic premium brands, that's the black line. So it stayed relatively consistent with just a lot of interchange between Bud Light and its key competitors. So let's talk about wine first, and then spirits, and I'll start it off. What we're showing here are table wine price tiers for the 12 months ending August 2022 in pink, and then the 12 months ending August 2023 in red. And we think it's really important to show those two periods together because of all the ups and downs and swings that Dale alluded to earlier. So let me just cover off quickly. This goes from, just go back quick. This goes from left to right, lower price to higher price. You can see the under 11 continues to be down double digits, although a little bit improved. 11 to 15 down moderately. And then when you get to the right-hand side and look at sort of that 2-year stack, there's a lot of ups and downs. But if you put it all together, that 15 plus is still a much better place to be than the left-hand side. So that sort of covers off, and there's a lot of sort of to 2022, a lot of ups, 2023, a lot of down that offset the ups from the prior year. Dale, why don't you break that down a little bit more for us and talk to sort of the size as well of some of these segments?
Yeah, and with these charts, and again, you'll see a number of these charts, the bar represents the percent of volume. And then on the right-hand axis, we have the dots that are the trend versus the same period 12 months ago. Sticking with those price tiers, and we see here that a significant amount of business of volume is still done in that below $8, but that area is down the most, and we anticipate that that's actually going to continue. That we'll continue to see the below $8 category decline. Don't think it'll decline as much as it is here, but we will continue to see declines. Moving to that middle section, we just had a very, very soft August that did impact some of these. We believe that right of this area, the $8 and above, those are going to come back some, but we really think that we'll see much better improvement in the 15 and over area. Smaller segments, but still having a big impact and definitely having a very, very sizable impact from a dollar standpoint. Looking at it by varietal, currently on a total basis, there is no varietal that is growing. Sauvignon Blanc, Pinot Grigio have had periods of growth where we have seen them grow. If you go to the over $15 only, we do see those varietals growing a little bit. This also kind of tells the story of a trend that we're seeing, and that is about white wine outperforming red and pink, and also sparkling currently. And you can see these are just representative of the trends. Year to date, in the 12 months, you can see that white wine is down much less. Rosé, thing I would say about rosé is remember that the bar for rosé is so much higher than it was, say, 7 years ago. We saw a good, robust growth on that. We're just pulling back on that. We believe that those also will moderate. And the sparkling category has done well in time. And I think it's important to think about the other categories that are out there as well. We've talked about this in the previous webinars about the situation with port, one brand driving that, largely based on a TikTok video, and that category continues to do very well. Seeing a little bit of growth in wine-based cocktails, not nearly to the extent that we are in spirits, which we'll talk about here in a second. And then we see sparkling wine, and sparkling down is down 6.3% on the rolling 12 months in total. But you really have that Prosecco being the animal that has continued to grow. And Prosecco does very, very well. However, the sparkling category, especially as we head into the holiday season where we do see a bit of a spike, wanted to take a little bit different look at it. And we broke this out, and by adding into this, and we see the sparkling other, and sparkling other is basically everything except Prosecco, Champagne, and Cava. But if we also put in attributes that are about price tier and whether it's an import or domestic brand, it really starts to tell a story of what's happening in sparkling wine, I think. These are left to right, looked at this from a price standpoint. So you have the under $8 to the left, and you have the highest priced items to the right. And what we see here is that domestic other under $8, there's still a lot of volume that is done in that area, and it's down almost 7%. However, that import under $8 is definitely taking share from that, because that's a little bit above flat, doing well. Prosecco in that $8 to $12, up 6.2%. And we again see an area struggling is the domestic $8 to $12.99. That segment is struggling, down 18.8. Moving to the $13 to $17.99, Prosecco really doing well. And that's not off a small base when you look at that. However, I want to point to that far right-hand side, and this is the higher priced items, and we're just really seeing some difficulty within those items as to what's going on with Champagne is struggling. We hope that we get to see that come back. With that, Danny, can you set the base for spirits?
Yeah, so let's talk about spirits, and I'm just going to show this one slide before turning it back to Dale, sort of replicating what I'd showed before on wine, the 2 years of growth rates for spirits, excluding RTDs by price tier. I just want to point out a couple almost differences versus wine. One is, and I think the most apparent one is, if you look at that under 10, so the value side of spirits, it's down a little bit, but only a little bit. It's doing much, much, much better than sort of the value side on wine. And we'll look at that because it goes across a couple key segments. It goes across both channels. So I think that's an important difference. When you get to the middle, start 17 to almost to 100. Again, we see some offsets. Last year was a little bit stronger. We're going against those strong comps, so we're down a little bit this year. But to some extent, they either offset each other, or even if you look at things over that 3-year time period, those segments are still relatively healthy. I think a big challenge, though, is almost similar to what Dale mentioned on Champagne, sort of the luxury end, is if you look at that $100 plus, that was up 11% last year. That's now down 14%. So it's down more this year than it was up last year. And I think there's a lot of pressure against that luxury segment as consumers sort of evaluate their spending. And keep in mind that a couple of years ago, they might not have been able to travel, or they might not have been able to go out and go to sporting events or entertainment events because of COVID-related lockdowns. But now all those things are lifted, and they can spend money in a lot of different places, not just on sort of the luxury end of wines and spirits. So that's playing into that, I think. So Dale, take us through again sort of how big are some of these segments?
Yeah, and this gives you an idea of the share, and we can see how big the 10 under 10 and 10 to 16.99 are. And Danny hit it here, and I think that as we look at this, that spirits category under $10, and a lot of that we have to remember is in on-premise does have an impact in that with well drinks and what's happening in that category. But we're seeing that area 25 to 49.99 and the 17 to 24.99 do better. And we anticipate that we're going to continue to see some of that, where the middle actually may perform better here in the short term. That leads to the question on what's happening with premiumization, and is the category premiumizing? And first and foremost, I always approach this from the standpoint that there's always going to be a consumer group out there that is premiumizing, that is trading up. It's just a matter of to what degree are they doing that. Right now, and we're looking purely at trend here. The blue bar segment represents the trend for over $25. The yellow represents collectively all the brands and all the products that are under $25. So we see on that left-hand side for total spirits that the over $25 is actually performing better than the under 25. That would give you the belief that there is some premiumization going on. It's key to understand where that is. And really right now, there's three categories where we're seeing the lower end under 25 outperform. Cognac's the obvious one. Cognac has really had a difficult couple of years here, been on a difficult run. That over 25, that's down 24%. While it's not a really large category, it does have an impact. On the other end of that is vodka, and vodka is a large category. And we're seeing the under 25 being down 3.8, where the over 25 is up 7 or down 7.3. Then tequila, and we'll talk more about tequila, but we're definitely seeing so much of that growth in that over $100. That was driven by tequila. Tequila was really one of the biggest players within that. As we see that pull back, we're seeing the under $25 tequila category actually perform pretty well. Looking at the spirits category by segment, again, the bars represent share. Look, what we see here is that we see in traditional spirits, we see tequila continuing to do well, but at a lower price segment. The cordial category has actually been holding its own. But the big driver is pre-mixed cocktails. And that's, as Danny mentioned, driven by that the RTDs. And when we look at the RTDs as to what's happening within that, with SipSource data, this is just kind of a one-page overview of breaking it out by different attributes. One story here, the on-premise is growing really strongly, up 47.2, where the off-premise is up 7.2. As you can see, it's being driven by canned products. The bottle, be it glass or PET, are both down, but that can is up 19%, and it's being driven largely by that 355 milliliter can, even though we do see some good growth in the 375 and the 200 sizes down there. A lot of that 375 and 200 is in glass package, but we know that there's a lot happening in this category, and we happen to have, I would say, the industry resident expert on RTDs that can give us more information.
So I'm going to take a kind of in some respects, a wider view, and maybe in some respects, not as wide a view. The wider view is I'm going to include not only RTD spirits, and a representation of that is on the right-hand side, but also what you might consider to be sort of that broader RTD view if we consider wine-based products in the middle, with some of the representation of some of those. And then on the far left, a really large segment in the beer category of both hard seltzers as well as flavored malt beverages. The flavored malt beverages, again, some of those are on the top part of that slide on the left-hand side. The hard seltzers on the bottom on the left-hand side. But in total, and this is just the Nielsen IQ measured off-premise channel, so it's restricted in this just off-premise. But again, this goes across beer, wines, and spirits, and it's irrespective of which distributor network, wine or spirits or beer this goes through. It's inclusive of all of that. It's $11 billion of consumer spending. That was about $6 billion back in 2019. $5 billion more that is not incremental to the alcoholic beverage category. As we know, alcoholic beverages in total aren't growing. So this $5 billion incremental is coming out of mainstream categories. If we put these RTD segments amidst where other prominent mainstream beer, wines, and spirits categories are. So you can see the 11 billion and how that breaks down with FM, the other blue columns here. You can see these are sizable segments that rival the size of mainstream categories amongst whether we're talking about beer or wine or spirits. So these have got to be very large segments that are commanding a lot of consumer interest and excitement. And they're having an impact on the shelf as well. So if we go back and look at the trend of the number of UPCs going back in time, Dale, if you can flip to the next one. There we go. And we're looking here at the number of UPCs going back to what that looked like in 2018 and how that's grown into 2023. Now the hard seltzers, which is the line on the bottom, obviously that grew quickly, but that's now leveling off because consumer demand is declining. But FMB offerings and assortment has grown. And the one that's obviously grown to the most sizable amount is spirit RTDs. You can see how that yellow line here has continued to grow in terms of its size as more and more RTD spirits have been introduced in the marketplace. And as that's happened, I mean, there is also just a ton of churn and change within the RTD spirits. And I thought this might be an interesting representation of that change in that if we look at the top 15 products within RTD spirits, and as Nielsen IQ defines RTD spirits, its products, RTDs, prepared cocktails less than 750 mil. You can see what the top 15 are in 2018, and all those ones that I highlighted in the kind of purple color aren't there anymore amongst the top 15 now. And if we look at the top, 15 in the year ago, 13 weeks to September of 2022, that's what the top 15 looked like a year ago, and all those things in green weren't there in 2018. Then if we look at the current 13 weeks, some of those products that were there last year in the top 15, like High Noon, Cutwater, Neutral, etc., were there last year, but there's a lot of new entries now into the top 15, all those ones in yellow. And in fact, 5 of the top 15 today, or about a third of the top 15, weren't in the top 15 last year. And I would expect this will continue to change because I looked at the latest 13 weeks and some other brands that are getting to be big and are growing at least at a 50% rate or more, and some of them are new, they will likely, at least some of them will show up in the top 15 if I look at that 2 months from now, 3 months from now, 4 months from now. So just a lot of change, a lot of churn. And we hear about, all the good things, and there are some good things because consumers certainly like these products. They like the variety, they like the flavors, they like the convenience. This category now, at least in terms of volume, is the second largest after vodka, bigger than American whiskey, bigger than tequila on volume. With continued growth, they do offer a potential bridge to mainstream spirit brands for those mainstream brands that have extended into RTD spirits, and presumably also act as a bit of a gateway for younger LDA consumers' entry into the spirits category. So there's a lot of good things, a lot of excitement. On the other hand, there's also some things that we need to be aware of that it's almost foreign for me to talk about depremiumization. I really had never talked about that all that much in my history watching, beer, wines, and spirits, but that's what we're seeing now in spirits, with volume growing faster than dollars. And there is the risk of cannibalization of mainstream spirits. There's that churn. There's the shelving challenges in terms of where all these products go. How should they be merchandised? What's the impact at the shelf? What's the impact in the cold box? And while, again, we certainly talk about brands that are growing and growing strongly, I think we also have to recognize that that's not universal. And so I looked at the latest 13 weeks and some large brands that are actually declining double digits, and these are all RTD spirit brands. And you can see some pretty significant brand names and some pretty significant losses in volume. So there's both sides of the equation to be considered. One other look, vodka, the vodka base is certainly the most dominant. That the bar represents the share of vodka-based cocktails, almost 60%, growing at about a 50% clip. But the second biggest category is tequila at about 20%, and it is now growing faster than vodka-based cocktails, taking advantage of the popularity of the tequila category, margaritas, etc. And so I know a question I get a lot is how long will the growth last? And I think it's still here for quite some time. It will slow down as just the base gets bigger. But I've just shown here on the left-hand side the Nielsen IQ scan numbers for off-premise, and then the on-premise numbers from SipSource on the right-hand side. And you can see some still really healthy growth rates. I mean, we're not talking, it's not single digits, it's double digits, it's pretty strong double digits. And even the reduction on the on-premise side, part of that is the channel shifting over because of COVID is now normalizing. So I would have expected it to slow down a bit, the growth rates, and it has. And even in on-premise, RTD cocktails now represent about 15% of total RTDs. So it's a big segment, not just in off-premise, but also in on-premise. So we're talking a little bit about channels. Let's go a little bit deeper into that now.
Thank you, Danny. And this slide is showing trends on the left-hand side, spirits, on the right-hand side, wine, and we've broken out the off-premise versus on-premise, and then you see the total. On the spirit side of things, we would really say that the on-premise for spirits remains resilient. You can see that in September of 22 last year, going back a year, we were still restocking and still kind of overcoming a lot of the shelter-in-place things as people moved back into the on-premise. But that 5.2 growth rate for spirits is stronger than where we thought it would be. For spirits, it really is about the off-premise, that we have just not seen depletion growth come back into the off-premise. We believe that that will come down. We think there's a lot of destocking at both the retail, certainly at the retail level, and even probably at the consumer level. On the wine side, just this month, for the first time, we saw the on-premise move into the negative, down just under 1%. However, we had until August seen a really nice slope on what's happening in depletions for the wine category in the off-premise. As you see, that line was moving up nicely. Again, we believe that that will come back and that we will get to see some growth there. But the key to growth is really all about the off-premise and how do we get the off-premise back to growth. But a little bit deeper dive on the on-premise. This is a year-to-date number, getting rid of some of the noise from the previous year. You see how big the categories are. Tequila moves to the left, and the tequila category becomes the number 2 selling category in the off-premise. 5% growth rate, that remains strong. Per Danny's point, that tequila is really, it's the second largest liquid that's going into the RTDs. So that 5% growth rate is really strong. Cordials, liqueurs doing well. U.S. whiskey maintains growth, and the gin category is doing very well in the on-premise, and that's really at higher prices. But the big story here is that growth in cocktails, and that cocktails continue to grow very large. Within the wine category, and we really have looked at this a little bit different, and as we think about again, share is the bar, the dots represent trend, and as we've broken this into high-priced, medium-priced, and low-priced items, and you can see the definitions down there in the box. What we're seeing here really, though, is the better performing items were tended to be in that middle area. Actually, medium-priced sparkling was doing better earlier in the year. It started to fade off a little bit, coming down. But going back to Danny's slide about inflation, where we see the on-premise really increasing price much more aggressively. But here what we see is that the operator likely is moving their cost base down. And instead of buying higher priced items, they're really buying lower priced items, which we believe is significant, and we'll see where that goes. With that, Danny, can you take a little bit deeper dive for us on what's happening in the on-premise?
Yeah, I mean, we put this slide together just to provide sort of a retrospective look at the on-premise share of spirits, on-premise share of wine, on-premise share of beer, where that is today versus where it was pre-pandemic. If the share today was where it was pre-pandemic, we'd see an index of 100, the share being consistent versus where it was. We're not seeing that. For spirits, we're getting close to where we were in terms of the share of on-premise, but even that's a little bit behind, and then that gets significantly lower for wine and even more so for beer. And there's a variety of both structural elements in terms of number of accounts that are open or not versus where we were, number of behavioral elements in terms of consumers getting more used to doing more things at home as they learned to do during COVID, some economic things around inflation rates and so on that we've talked about. So all of those things are playing into on-premise being still exceptionally important for the business that you do there and for the trial that it generates for consumers trying products, etc. But it's still struggling to get back to where we were back in 2019. We also took a look at both for wine and for spirits, what channels and sub-channels are doing better and what ones are doing not as well. So the further off to the right we go, channels are doing better. The further off to the left, those channels or sub-channels are not doing as well compared to the overall category. And for, this is off-premise first, again, some consistent things. One is that some sort of the value discount type retailers, mass merchandisers, where Walmart, would, for instance, would fit in, are doing better. And then the other channel that's doing quite well across beer, wines, and spirits actually are convenience stores, and in particular, convenience store chains. So I would hold mass merchandisers and convenience store chains as the sub-channels kind of doing the best on this slide. If we go to the left-hand side, it's no surprise drug is still difficult, as well as the other one that's now showing up here is club. You can get some great deals if you buy in quantity in club, obviously, just in general, but you can also spend a whole lot of money in a club store, and I think maybe the economy is impacting that. On the on-premise side, two channels that stick out to me in terms of good performance or recreation channels, golf clubs, entertainment places, private clubs, et cetera, are doing quite well, in particular chains, as well as the transportation channel as people return to traveling. And that's a very small channel, but obviously growing quite strongly. And then just on the far left-hand side, if you look at lodging and dining, the one thing that's quite consistent, first of all, it's still positive, even though it's on the left-hand side, so not doing as well as the right-hand side, but still positive. And chains are certainly outperforming independents. Independents have got a lot more sort of struggles financially, economically. Chains might be better off able to kind of withstand some of those challenges. And the one last channel I want to talk to, obviously it's not included in the SipSource data, but from our friends at Sovo Ship Compliant and Wine Business Analytics is the DTC channel, and these are DTC shipments for wine. The DTC channel is not standing out as offsetting the losses in the three-tier channel. It is also down. It was down in 2022, but year to date through August of 2023, volume is down 8%. Dollars are down 3%, and underneath that you can see that that's largely sort of the under $50 segment not doing well at all, but even the 50 to 100 and 100 plus, it's holding its own, but it's not growing. So this channel's important, but it's not offsetting the declines that we're seeing in the three-tier side of things. So we've talked about what we've seen. What do we think about the next few months as we sort of head to the finish line here, Dale?
Yeah, and in the last 10 minutes here, we're really going to try and chat about what does the future look like. And the headline for Danny and I would be, it's going to get better, but don't expect any miracles. We really do need to temper our expectations of growth because we do think that growth will be moderate. And even if we're able to get back to growth, certainly by the end of 2023, but a little bit different picture as we head into 2024. Looking at the holiday season, it is important to remember that consumers do premiumize during the holiday, and spirits are on the left here, wine on the right. And all we've done is look at what share premium priced items have on a quarterly basis. And we've done this, as you can see, over a long term. And that 3-month share is always bigger during the holiday. I'm sorry, that over 25 or over 15 table wine definitely does premiumize. We see consumers move up and they do get a bigger share of that business, and they buy better items, be it for gifting or for family engagements and family get-togethers. So that we look at that and think that that's a positive. However, there are some headwinds that also play into that, don't they, Dan?
Yeah, if we talk to consumers as our friends at Nielsen IQ have done, and then Morning Consult has also done in the next slide, which I'll show in a second. Consumers are they're concerned, they're pressured. We talked about consumer confidence being a bit lower. There's lots of things going on economically, geopolitically, et cetera, that are concerning. So this Nielsen IQ survey was all about asking consumers, will they spend the same, less or nothing overall for holiday celebrations and special occasions or for socializing and gatherings? And if you look at the opposite of 84 or 82 minus 100, that says there's only 16 or 18% that say they're going to spend more. The balance will either sort of hold their spending consistent, or in the red number or the red bar, part of the circle is pretty large. They're saying they're going to spend less. I always caution people on surveys that when we look at it, what people say they're going to do is not necessarily what they end up doing, but it's something we need to consider. And on the Morning Consult survey, where they ask about some specific subcategories, the question they asked, are you considering spending more, the same amount, or less on certain classes of goods for the upcoming holiday versus what you did last year? And if you look at the alcohol numbers, that's 12% said they're going to spend more, 47% said the same amount, and a whopping 42% said they're going to spend less. So that's, again, just some headwinds in terms of, what are consumers, how are they thinking as they go into the holidays? And that's just another reason why Dale and I are suggesting that we at least temper our growth expectations given everything that's going on. So let's go a little bit one step deeper on comps before we end up, and Dale, why don't you take us through that?
Yeah, again, looking at the 3 periods that are listed at the bottom, and what we've now done is broken mainstream spirits down. So this does not include RTDs, and show you what those growth rates look. All of you have products that are falling into some of these price categories. So as we look at the holiday season coming up here, you can see that the pullback on that high end of spirits really started to occur in the holiday season of last year, where the consumer pulled back and accelerated in Q1 of 2023. Still some growth rates there in the middle during the holiday season, which some of those consumers traded down. If we look at table wine, we see what happened here, that really the overall just soft comps for the table wine segment. The only bright spot is in that Q1 that we did start to see the over 50, and we saw a little bit of a jump in Q1 on the over $50. But these comps are really soft, and something that we would expect should be not that difficult to overcome. Similar story for sparkling wine. You see the big pullback on the higher priced items kicking in last holiday season and accelerating during Q1 of next year. So as we look out on this kind of 6-7 month horizon, we do believe we will see improvement. I do think these numbers are too large to overcome to think that we would get back anywhere near a growth rate, but we do expect to see definitely some improvement. And then just on the spirit side, wanted to just, as we thought about, okay, if we were going to go start to try and drive sales, where are you going to try and drive sales? And these are year-to-date numbers. And the 2 places that I would always try and get growth: one, is it a big category? Can I move the needle? And then number 2, is there consumer acceptance, and are we seeing some growth rates? So vodka, a big category, can you get something done there? Then when we start to look at that, and in the middle there, you see tequila. And we've got tequila really from the $17 to $50 price range. Those are doing well. And those are performing, and year to date still continuing to grow. However, that's being offset, if you go further down, by the tequila 50 to 99.99. That's down 4%, but then tequila under $10 is growing at 20%. And that growth is very, very balanced between the on and the off premise. So high-end Scotch, middle-price Scotch seems to be doing well. Cordials on the low end, and actually cordials in the mid-price also doing very, very well. So just some thought and looking at it a little bit deeper. With that, Danny, if you could, can you kind of recap our thoughts and talk about what it means to the audience as we look forward?
Yeah, so here's some summary points. We've lived through this COVID spike, and I think that created some things that were quite different than maybe we had experienced before then, some good and some not so good. But that spike, especially for the spirits category and especially for the luxury end of wine, I think we've got to say to ourselves that that might have been a one-time thing and it's done. There was, we're past that point, and we that might have influenced some of our high lofty growth expectations, but that is in the rearview mirror now. The economy is relatively resilient, certainly things like low unemployment, but there's still impacts in terms of inflation. High interest rates is causing both consumer and business challenges. We've got all the economic, political, and global factors weighing on consumers. So I think there's probably more struggling and cautious consumers than there was, say, last year, and less insulated and thriving consumers. Premiumization, it's still there, but the levels are not what they were before. So the levels are waning, and the sort of that luxury end is vulnerable. We've seen growth in some channels, convenience store for sure, value and discount retailers, maybe more than we have talked about in the past. And then on the on-premise, that sort of recreation, I guess I could put in there, that transportation channel. RTDs certainly getting increasingly crowded. I think there's certainly going to be more and more need to sort out the true winners from others, and it'd be more important than ever to sort out, not just trial of products, but also repeat rates, and are they strong or not so strong. A lot of proliferation of SKUs and the impact on space. It will remain a hotbed of new entries and some innovation. And I think there'll certainly be some efforts to premiumize that segment. And I see that already happening in the marketplace. Dale mentioned the on-premise, that it's stabilized, but it is a challenge to get back to its pre-COVID levels. The off-premise is where the most negative pressure is right now. We'll likely see a lift in e-commerce and other sorts of convenient shopping over the holidays. And then I think there'll be certainly more promotional efforts, but it'll be really important to sort out the effectiveness of those promotions and really understand what gets you the most bang for your buck. And in a nutshell, because there's less overall growth to find, it's really more important than ever to both size out the true size of these product classes and price tiers and segments, and dig probably deeper than you've had to dig before to find those growth segments. So that kind of leaves us with the original question of which way will the pendulum swing?
Yeah, and as we've been saying, we think there's going to be a slight improvement. We will see a slightly upward swing. It's going to get better, but it's important to be realistic as to what that looks like. Wine will remain negative, but it should swing to less so. We will see some improvement. And then spirits will swing to flat. In my view, swing to flat's probably the best case scenario. We've got a very big hill to climb in the last 4 months with this. Could happen, but again, it's going to be a tough ask to get there. So in general, cautiously optimistic is probably the best two-word phrase. But then that really does, what does it mean for you? And we came across this photo that really kind of feels like where the consumer is now. Are they climbing upward? Are they hanging on? Or is it going to fall off? And we, as Danny said, the next 6 months, we really believe are very critical. And that we will know that answer within 6 months as to really where the category stands and where we are. So we're watching it closely and keeping our fingers crossed. Danny?
Yeah, no, I think those are good questions, not only in terms of the consumer, but what does it mean for our audience today? Are you climbing upwards, hanging on, or falling off? And we hope we hope that certainly the climbing upward holds for you. I know there were also some. I was looking at one question about the impact of cannabis and so on. There are consumers have more and more choices, including cannabis. That's that I keep saying that's not helping our cause here. But also there's things like social moderation. There's a whole bunch of other factors that are impacting these categories. So, we've got lots to consider, positive, negative, headwinds, tailwinds, but want to thank everyone for their time, Dale, and
right on time.
have our emails up here if you have any questions. If you have any questions about SipSource, Eric's email is here, so please feel free to reach out. And we really appreciate your time today, and we wish you best of holidays.
Thank you, everybody.